everybody. It's Mike Preston at New Harbor Financial Group. It's Thursday, February 8th, 2024. Here with a brief weekly update. I'd like to give you some insight and some advice and hopefully things you can use in your investing life. And a lot is going on in the market. The market's been pretty relentlessly up since October. It's quite surprising. I think that investors are feeling locked out of this market. You could term it a melt up, although it really hasn't gone parabolic yet. I think the market might very well do that. I don't want to make any predictions or any guesses about how high it can go, but we are on thin ice. And I'll talk about some of the reasons why, but this market just hasn't pulled back even one bit. I believe we're in a final move higher that's going to lead to the big market drop that we've been talking about for a lot of years. But we'll see. We're doing our best to react to what we're seeing. I'd like to share a chart with you and just go over some of the things that we're noticing. So here's a chart of the S&P 500. Here we are at 4,993.7. You can see yesterday we hit 4,999.89. So basically we're S&P 5,000. So let's take a look at some of the mixed signals we're seeing. And this is really the problem with managing money here today, whether you're a professional managing for others or whether you're managing for yourself. It's a really hard time. And it has been, to be honest, for a number of years. But now is even harder, I think, than it's been in a lot of years. And the reason is the most dangerous points to be an investor is at inflection points. And so it's all great when the trend is your friend and the dips can be bought and everyone's making money, but the fundamentals tell us that we're facing ever-present crash danger. So, and predicting a crash is extremely hard. We can't say that that's going to happen. It should happen at some point. All super bubbles like we're in end the same way in some kind of burst. But right now, since October or so, we've had a straight up move. In fact, let me just move to the weekly chart for a minute. We have had one down week in 15 weeks. And that down week was a very small one here, back in the first week of the year, actually. So it's been a straight up move. Going back to the daily chart, you can see that it's gotten a little bit extended. But let's talk about the good and the bad. First, probably the bad. The things that we look at that measure risk, like a number of different things, but short-term indicators like bullish percents, and things like participation in the market, looking at market breadth, these things have all been bad. The short-term indicators, for instance, bullish percents, taking a look at the number of issues in each of the main indexes that are on buy signals versus sell signals, is negative across all three main indexes, the S&P, the NASDAQ, and the Dow Jones. And so constantly looking out for why that's happening. And really the reason it's happening is because breadth is bad. There was a time not long ago, just a few months ago, where we started to see a widening of participation. The Russell 2000, which is mid-cap stocks, and the S&P 500 equal weighted index started to participate in a way greater than the cap weighted or capitalization weighted S&P and NASDAQ. That's reversed. In fact, we have stocks like NVIDIA up again. NVIDIA is up almost 40% year to date after having a monster year last year. So again, we're back to the Mag 6 or Mag 7. The S&P equal weighted is not participating as much. Here's the equal weighted S&P, basically flat year to date. Let's take a look at the Russell 2000. Is down year to date. As you can see, this vertical dotted line is the beginning of the year. But if we look at the NASDAQ, it's solidly up. If we look at the S&P, we can see that it's solidly up. So here we're sitting right here at 5,000. It's a nice round number. I doubt the market is going to reverse right here, but we have to be ever cautious about what we're seeing here. Big round numbers generally act as magnets. But the negative things that we're seeing in the market, namely the bullish percents on sell signals, the really, really bad participation. We're in a very concentrated market. Again, you can see that we're very stretched above the 50-day moving average. The 50-day moving average is this red line. and the 200-day moving average, which is this green line, we're solidly above these. And so that's not to say they can't get more stretched or that they have to meet at some point. They will meet at some point. It might be at higher levels. But just bear in mind that with only 1 out of 15 weeks down in the last 4 months and a straight up move in the market, the risks of a pullback are increasing. And of course, there's the fundamentals. Earnings are not where they need to be to justify the valuations of this market. And we don't even really know how much earnings have been juiced by central bank money printing. We think obviously a lot. We've seen deficit spending by the government for the last few years, particularly post-COVID. That type of stimulus, which equaled around $7 trillion since 2020, is not permanent, nor is it sustainable. We have to often manage our investments, whether we're individual investors or professional investors, based on what we see right now, but ever conscious of the reversal risk. Some things that are positive, let me just go over the things that are positive. There's really no technical sell signals yet, other than there's a warning from bullish percents and breadth and things like that. There's no confirmation to the downside. In fact, the market's had almost no down moves. There's some sectors that are performing very well. They're in our portfolio. Things like insurance sector, industrials, healthcare is showing very strong relative strength, and we'll be adding it to our portfolio soon. And of course, technology. All of the actual technical indicators are still moving up, but short-term things, there's these warning signs, these red flags, so to speak, or yellow flags, maybe I should say, caution flags, that are telling us to be careful. So we're up to about 38 or 39% stock exposure here, though we have a hedge on 15% roughly of notional of account value, right here down at 4,500, this orange line. As we see this market continue to move higher, we're adjusting our hedges. So we'll be closing out this 4,500 hedge very soon and moving the hedge up to 4,700. The upshot of that is that we'll reduce from around 38 to 40% stock immediately down to around 23 to 25% if we get some kind of crash. So we're doing our best to ride the trend, but we're ever cautious about what we think is a reversal or crash risk. So this is the 10-year United States Treasury bond, which quickly went from 5% to 3.8%. And so this was a pretty big meltdown in bond prices. We have a long-term bond position on. We have been managing it with options. We got out of half of the position on a recent bounce, and we'll be looking to add back at some point, potentially. But this 10-year yield, which went from 5% down to 3.8, we believe is likely to move higher. And take a look at these horizontal lines. These are what are called Fibonacci lines. There's no magic science to this, nor are they guarantees, but they're guidelines to what a normal retracement would be. A normal retracement would be the 38, 50, or 62% line. Just basically looking at the chart structure here. And again, no guarantees, but it looks like we should see 4.2 to 4.5 on a normal retracement. So up in this area, it would make some sense to increase your exposure to medium to longer term bonds. This is probably a good time to roll out some of your short-term CDs and Treasury bills to slightly longer. Taking a look at the Treasury yield curve, it's still strongly inverted. It won't stay that way forever. The short-term yields will plummet at some point, and you're going to want to lock in some longer-term rates. So my suggestion, if you don't have any longer-term exposure at all, is as we move into this area, 4.2 to 4.5, start moving out longer. If you don't have any longer exposure, I'd buy 10 to 20% in longer term bonds. The 10-year bond would be fine if you're buying treasuries directly. And for your short-term treasury bills that you might have 1, 2, and 3 month treasury bills, move a chunk out to 1 to 2 years. Another maybe 20%. Put 10 to 15% in the 1 year, another 10 to 15% in the 2 year, and a chunk up to 20%, like I just said, in the 10-year, and everything else can be in the short-term treasury bills, and I think that will serve you well. So we'll probably get a reversal at some point. It's our belief that treasury yields will go a lot lower, maybe down to 3% again on the 10-year as we get a drop in this market. So big picture on the S&P, if I can just move to the monthly here, it's been an insane ride, and it hasn't been easy for people that have questioned the reality of what we're living with here. This endless money printing system that we're in, where recessions are not allowed, has not been an easy thing to deal with for an investor that's looks at the data, an investor that's skeptical about the magic of money printing. It's not been an easy time. How does this all end? I don't know. Every bubble ends in a burst. And we can see here that we've had a massive bounce after COVID, followed by a relatively small pullback. And now we're at a new high. One thing that I'm noticing is I'm not really seeing a lot of fear of missing out with the people that we're talking with or the public yet. So I think it's possible that we move higher here in a short period of time. Not that we should, because I think we're going to end up a lot lower after this bear market is finished, but we may need one more gasp higher just to pull everybody in. And then I think the bear market was going to be very substantial. So we're doing our best to participate a little bit without risking too much. And our hedges, we keep moving them up with the market so that when we get a reversal, we won't give back very much. So that's what we're going to keep doing. And I thank you for watching, and please tune in next week. And if you have any questions, give us a call, shoot us an email. Always happy to speak with you. Until next time, this is Mike Preston at New Harbor Financial. Thank you.